Settle us down a bit. Markets obviously jumpy. The triple Qs had nearly triple the normal traded volume yesterday. As on an average day, there is a lot of nerves around some of these former and maybe still market leaders.
Most cases, particularly with the major names like Microsoft reporting tonight, a microeconomic or company-specific issue. I actually expect that company to be solid tonight with solid guidance, but frankly, Brian, I don't know if it matters. Before I go back in the sector, and of course I'm focused on the sector with my career for a long, long time, and I have a lot of cash, extraordinary amount of cash in portfolios, I need to see one of two things happen. I need to see us clear this entire quarterly reporting season, which will probably go for another 3 weeks, so we're a little bit early on the calendar. And frankly, I need to see, at least in the short term, some kind of stabilization in rates. I'm not fool enough to think that I'm not going to get back into the market until we have the Fed complete its whole tightening program, because that could take years. But I need some sort of stabilization, at least in the next couple of weeks or months. When that happens, I feel very comfortable to go back in tech. I think we're shaping up with some extraordinary bargains here for some great companies.
So tie it together, Paul, and you and I, we're old, man. We've been talking together for, I think, more than 20 years now. We've been through a lot of cycles. Haven't been a lot of cycles lately, but we've lived through a few. And I guess where I'm confused, and please hit me over the head and tell me why I'm wrong, is why it would matter to Microsoft or Apple or Google if the Fed raises rates 1.5% or 1.25%. I understand why it matters to money-losing 200 forward PE companies. I get that. It's a multiple compression. Why does it matter to Microsoft? Why do they care?
I still think it matters vis-a-vis multiple compression, at least a bit, but obviously not as much as some of those, COVID-derived darlings, tech darlings from yesteryear. It still does matter. You think about Apple, for example, growth is starting to slow somewhat, big, fairly mature company, yet its multiple has exploded in the last year or so. And so I do think, and I don't mean to disagree, I respect your opinion, I do think it does have some sort of impact, but obviously not as much as some of those stocks. And it's reflected in some of those former tech darlings, because they're down 30, 40, 50% in some cases.
I want you to disagree. That's what makes it fun, Paul. No problem at all. But I guess what you would say is that Microsoft's valuation then was a little bit stretched. If the rate rise and compression matters, that would imply Microsoft's forward valuation was a little too high. It was at 37 times forward earnings in mid-December. It's at 32 now. So it has come down 5 points. What would be sort of a fair level then?
Well, I think that Microsoft, once we get through the report, if it's clean and the guidance is clean as I expect, I think we're probably getting fairly close to a buying opportunity. Maybe not for the short-term investor, because we still have this cloud of the rate hikes, but for a long-term investor. I mean, of the FANGs, I think Microsoft and Alphabet are probably okay. I actually worry about the regulatory heat on Facebook, and I worry about Amazon's business. But Microsoft and Alphabet, for long-term investors, get through the quarterly reporting period, Brian, I think they'll be just fine.